everyone, and welcome back to the Cox Automotive Fall Expo 2021 User Summit. I'm Lance Helgeson with vAuto, and I'm honored to be back as your MC and host for the second day of Inventory Management Solutions sessions here at the User Summit. Now, I thought yesterday's sessions on vehicle sourcing and acquisition were rich with best practices and ideas to help all of you get the used vehicle inventory you need, whether it comes from customers or auctions. This morning, we're going to change gears and take a closer look at how all of you can improve the way you manage used vehicles at your dealerships once you own them. Now, just like yesterday, Paul Whitworth, Senior Vice President for the Inventory Management Solutions Group, has a few opening remarks to share before we dive into today's presentations. Paul, take it away.
Thanks, Lance. Hi, everyone. Welcome back. For those of you joining us for the first time, I'm Paul Whitworth. I lead our Inventory Management Solutions Group at Cox Automotive. Thanks again for your ongoing business and partnership with Cox Automotive. Yesterday, we had a very informative set of sessions on inventory sourcing. And today, we're going to share insights and perspectives about inventory management. We have 4 sessions in total for today. For the first one, we're going to hear from vAuto founder and my friend Dale Pollak. Dale's going to talk to us about the investment value method of used vehicle management and how this method is providing superior outcomes for dealers. He's also going to give us a firsthand look at the data science behind the methodology. In the second session, we're looking to help you better handle your reconditioning efficiency and speed. We have this one metric we call time on task that we think is critical and that we're going to talk with you about. In the third session today, we're going to focus in on vehicle merchandising and the changes that you might need to make to meet the expectations of today's online buyers. And we're going to close the day out with the fourth session, which is going to focus in on wholesale. And we're going to show you a new way to send cars to wholesale that saves time and increases wholesale profits. So in addition to all that, throughout the day, we're going to share with you some new innovations brought to you by our engineering teams in the form of new features embedded in our products that we're very excited about and we think you will find interesting as well. So on behalf of our team at Cox Automotive and myself, thanks for taking the time to participate today. And we hope you'll learn some new things that will bring you better success in the weeks and months ahead. Lance, let's kick off our first session.
Thank you, Paul. Absolutely. Let's get started. Now, as Paul mentioned, our first session in today's IMS User Summit Inventory Track comes from Cox Automotive Executive Vice President and vAuto founder Dale Pollak. Nearly 3 years ago, Dale noticed that something was amiss in the used vehicle business. Dealers were selling record volumes of vehicles, while gross profits and overall departmental profitability had effectively gone away. In today's opening session, Dale discusses the data science work that led to the development of a new way of managing used vehicles, not as inventory, but as distinct investments. Dale will share how the investment value method of management has come about and how it's proving to be a better way for dealers to optimize their used vehicle sales and profits than managing inventory as merchandise that needs to be sold as quickly as possible. Dale, take it away.
Thank you very much, Lance. I'm very proud and thrilled to be part of this year's Cox Automotive Fall Expo. And before we start our presentation formally, I just want to note the moment of the market that we're in right now. To be sure, the last 18 months have been very, very interesting and very unusual for car dealers and also very fortunate. And what I'm going to talk to you about today represents a very substantial change to used vehicle management strategy. And it's worth taking just a moment to ask ourselves the question, why? Why, in light of the fact that most dealers have achieved record or near record results, would we possibly think about doing anything different? And the answer is because these conditions that we're operating in today are anything but the new normal. They are conditions that have set themselves up as a result of COVID-related conditions. Unprecedented government stimulus, money virtually falling from the skies into consumers' bank accounts. And for the most part, over the course of the last 18 months, people have been locked down, not spending money or doing things that they otherwise would do in the area of travel and leisure and restaurants and bars. Consequently, household savings are at record high. And one of the outcomes for American consumers with record household savings is that they will spend it. And certainly one of the things that they've been spending on robustly are automobile purchases, and particularly used vehicles. So these conditions, as fortunate as they are, will subside. It's inevitable that money will at some point stop flowing generously from the government, and people will spend down their household savings. And what we will return to is what I would consider to be a new normal, or the real normal of the used car business, which I suspect will look very much like the years up to the pandemic, specifically 2017, 18, and 19. And if you can remember back to those days, I think it's well understood that one of the greatest challenges that dealers had was to achieve gross profit outcomes that were acceptable and positive net profits. These were extremely challenging years in that respect. And I suspect that that is what we will encounter at some point in the future. So it's entirely possible that at this moment, you might want to sit back and just write it out as long as you can with no change. But I would suggest that the true mark of leadership, and for those most successful dealerships, is that they're never satisfied. They look to the future. They prepare themselves today for the future. And it's in that spirit that I come to you today with a case for change, and a very substantial change in the way that used vehicles are managed. And specifically, what I'm talking about is taking an investment-minded approach using vAuto's profit time system to managing used vehicles. And before I formally introduce the new strategy, it's worthy and worthwhile to take a step back and just consider for a few moments how our industry has in the past achieved net profitability in the used vehicle department. And I think it's fair to say that prior to roughly the past 15 years, the strategy for making profit in the used vehicle department depended on selling as many vehicles as possible at the highest possible gross profit. And about 15 years ago, I and vAuto came along and we said, hey, wait a minute, maybe if we tweaked that basic formula just a little bit, we could generate even more profit in that, or gross profit, that is, total gross profit. And the way that I recommended that we do that is if we put a little less emphasis on our average gross, we would more than make it up with additional volume and generate more total gross, from which we deduct our expenses and have net profit left over. And 15 years ago, that was somewhat of a novel idea, but in fact, it caught on, and it caught on in a big way, which really fueled the success of vAuto. And I think it's fair to say that over those years, many dealers not only found a lot of success using what we called the velocity method of management, which our software is purpose-built to support, but many dealers have even attributed the velocity method of management to survival in some very difficult periods like 2008 and 2009. But what occurred, and it began to occur to me, was occurring sometime in late 2016, early 2017, is that velocity method of management, which fueled our company's growth and the success of many dealers, was beginning to wane. And in fact, at some dealerships, it just wasn't working at all. And why was that happening? Because at some point, once too many dealers begin to do the same thing, it essentially did in fact become a race to the bottom. Something that I didn't think would happen, something that I didn't want to believe would happen, but in fact actually happened. And at some point, the average gross profit goes so low that there just isn't enough additional volume to compensate for it. And this is exactly what began to happen, or I began to recognize was happening late 2016 into early 2017. And that represented a significant problem for me because I'm certainly not going to do anything to hurt a dealer. And I began to recognize that continuing to espouse the velocity method of management, that strategy that really we built our company on, was not helping dealers, was not serving the interests of dealers. And if I can't help a dealer, I'm certainly not going to continue to espouse a philosophy that doesn't serve their interests. So those were some dark days for me in that period of time. And before I was willing to hang it up, which I gave considerable thought to and right off into the sunset, I committed myself to taking one last look to see if there wasn't a better way forward. And in all candor, I had about zero optimism that I would actually find a better way forward. But we did, in fact, find one. And that's why I'm still here today. And that better way forward is taking what we call an investment-minded approach to managing used vehicle inventory. And when I say those words, taking an investment-minded approach to used vehicle inventory, it's entirely possible that you think to yourself, well, that is, in fact, what I already do. And that is not what you do. And I'm going to prove to you today that that's not what you do. And in fact, not only do you not take an investment-minded approach to managing used vehicle inventory, you actually do the opposite. Your behavior, or the industry's behavior across the board, is such that it's actually designed to suboptimize the return on our used vehicle inventory. So just to begin to make that case for you that we don't manage inventory with an investment mind, I would give you this illustration. Suppose I told you that you sold a used vehicle and you made a $2,500 front end gross. Every single person in the industry would say on a used vehicle that that is a pretty good outcome. And a $2,500 front end gross on a used vehicle might be a pretty good outcome, but it might not. Or it might not be as good as you think it is. Allow me to explain. Suppose I told you that you sold a used vehicle that you had $50,000 in, and it took you 60 days to do it, and you made a $2,500 front end gross. Is that the same outcome for your used vehicle business as if you sold a $15,000 unit in 20 days and made a $2,500 gross profit? Are those the same two outcomes? They're the same two gross profits, but are they the same two outcomes for a used car business? And put that way, the obvious answer is they are not. In fact, they are two different ROIs, return on investment, two very drastically different ROIs. But yet, if any dealer today saw two deals on their sold log, both of which grossed $2,500, not a single dealer would ask or even think to ask, wait a minute, how much did we have to invest to make that $2,500? How long did we have to have that investment tied up to make that $2,500? Not a single dealer would even think to ask those questions. And therein lies proof. Therein lies proof that even if we believe that we manage used vehicles with an eye towards optimizing their ROI, we don't. Because if we did, we would certainly ask those questions every single time we saw a sale on our log sheet, but we don't. So the reality is, and we know this factually if we look back to the years 2018-19, those years leading up to the pandemic, what we know is that a lot of dealers sold record volumes of used vehicles. A lot of dealers generated significant amount of total gross profit and still lost money on the net line. However, any business of any type that generates a positive return on investment on their assets is profitable. And the higher that ROI is, the more profitable they are. one of the most vivid experiences I had through the years was in the year of 2018. It was January 2018, 2017. It just concluded. And I got a call from one of the largest Ford dealers in America. Everybody knows the name of this Ford store. And the owner of this store said, Dale, last year in 2017, we had a record volume used car year and we lost money. And I said, I know, I understand. This is what is beginning to happen all over the industry. In fact, our industry in the years 2017, 18, and 19 had record volume used car years or near record volume in each one of those 3 years. And yet, according to NADA, in each of those 3 years, roughly half of the dealers in America had a negative net profit in their used vehicle department, in spite of record volume. And can I tell you something about the other half that were fortunate enough to make a net profit? In most every case, the net profit they did make in each of those years consecutively declined, headed down to zero each year. And again, I have to say, in spite of record volume. So we can no longer believe that just selling volume of used cars is going to result in net profitability. And I also want to remind everyone that the reason we get paid to go to work in that used car department is not to sell used cars. It's not to make grosses. It's to make net profit. That's why we get paid to go to work in that department. And under what I would consider to be the real normal of our used car business, not this particular pandemic moment, but the real normal that will eventually return, is I suspect that we're going to be in a similar condition where most dealers are going to struggle to make any net profit whatsoever in the used car business. And this is why I am now calling for a change of strategy of used car management, a strategy that is designed to optimize the return on investment on every single vehicle in stock. So back in 2017, when I began to recognize this problem, we had a couple of good things going for us. Number one, we had the benefit of having done business with thousands of dealers, over 10,000 dealers for the better part of the prior decade. And we had millions of used vehicle transactions in our database. The second benefit and blessing that we had in those years, thanks to Cox Automotive, was we had the assistance of some very brilliant data scientists. And the data scientists went to work on those several million transactions to see if they couldn't find a better way forward for our industry. And as I mentioned a moment ago, we did find a better way. And what we discovered is that the investment value methodology of managing used vehicles would in fact produce superior outcomes in the net profit line, the line that really matters. So what the data scientists initially did is they took about 2 million used vehicle transactions that we had watched go through dealers' inventories through the prior decade, and they segmented them into 3 groups. Ones that achieved the highest ROI outcomes when they eventually sold, the ones that achieved a mid-range ROI, and then the bottom ROI third. The bottom ROI third represented dealers that sold vehicles, I should say, that sold at dealers that produced little, if any, and very often a negative return on investment. And then what the data scientists sought to find is whether there are any common characteristics or conditions of those vehicles in dealers' inventories that when they sold produced the highest ROIs versus common conditions of those vehicles that produced the lowest ROI. And what they found is that there are many characteristics and conditions of vehicles that are highly correlated to their ultimate ROI outcomes upon sale. There are many. But among all of the conditions and characteristics that are highly reflective of the vehicle's ultimate future ROI outcome, there are 3 that far and away among all the others are highly predictive, highly reflective, highly correlated to the ultimate ROI outcome, high or low, when the vehicle transacts. And I'm going to share with you what those 3 conditions and characteristics are, and not one of them is going to surprise anybody. Each one individually is going to make intuitive sense. So the first condition, highly reflective of a vehicle's ultimate ROI outcome, high or low, is simply how right the dealer owns the vehicle measured by its cost to market. And that makes intuitive sense to everyone, because the more right we're in a vehicle, the more likely we are to make a larger gross profit when the vehicle sells. The second condition, highly predictive of the vehicle's ROI outcome, is its market day supply. And that one too makes intuitive sense to everybody. Because when a vehicle is in high demand and short supply, and you're lucky enough to have it on your lot, you have a much better ability to command your price. In other words, discount less, and in some cases, not discount at all. And the third condition, highly reflective of the vehicle's ultimate ROI outcome, is simply its popularity in the retail market measured by its retail volume. And that too makes intuitive sense to everyone. So having identified these three conditions as being highly reflective of the vehicle's ultimate ROI outcome, what our data scientists did is they melded those three conditions together into what we called an investment score. And through the better part of the year of 2017 and all the way through 2018, and to this day, behind the scenes or on the screen, as the case may be, we actually assigned an investment score to every vehicle every day. And I'm going to explain how that investment score works. It's on a scale of 1 to 12. So for example, a vehicle in a dealer's inventory that would possibly receive an investment score of 12 today would be characterized by a vehicle that we're in it really right. We have a low cost to market. It's got a low market day supply, and it has high retail volume in the market. This is a vehicle that we could predict with a high degree of certainty that when it sells in the dealer's inventory will achieve among the highest ROIs. And on the other end of the spectrum, a vehicle in a dealer's inventory today that might score 1 on that scale would be the opposite. It would be a vehicle that we could predict with a high degree of certainty that when it does transact, it's likely to produce little, if any, and very likely a negative ROI. That would be a vehicle that would be characterized by a high cost to market. We're in it for a lot of money, maybe too much money. A vehicle that's got high market day supply, and a vehicle that's got low retail volume. So after we score every vehicle in a dealer's inventory every day on that scale of 1 to 12, we then group them into 4 categories. The vehicles on a given day that score between 10 and 12, we call those platinum vehicles. Again, these are the vehicles that we could predict with great certainty will produce among the highest returns when they sell. Followed by what we call the gold vehicles, the ones today in a dealer's inventory that score 7 to 9, followed by silver, the vehicles that score 4 to 6, followed by what we call the bronze vehicles, the ones that score 1 to 3. And again, those are the vehicles we could likely predict with certainty will produce little, if any, perhaps negative ROIs. So there was a moment in our journey back in late 2017, when I asked the data scientists to do a couple things and answer a couple questions, that once they did those things and they gave me the answers to the questions, I knew 2 things with certainty. I knew, number one, that I wasn't ready to retire and ride off into the sunset. And the second thing I knew with certainty, as I believe today, and that is that eventually, not overnight, but eventually we will change the way that every single dealer manages used vehicle inventory. So what led me to those 2 important conclusions? Well, one day I said to the data scientists, I said, okay, we are now scoring every vehicle in every dealer's inventory, at that point over 12,000 dealers. I said, do this for me. I say, take all 12,000 dealers or so, roll them up together as if they're just one big used car enterprise, and show me what their inventory looks like in these 4 investment precious metal buckets. And this is what they showed me. Now, there may be several things here that are worthy of discussion, worthy of questioning. But there's one thing here that should absolutely leap off the screen and scream patent irrationality. Patent irrationality. And if you haven't noticed what that is, what it is that the bronze vehicles, the ones that these dealers own for the most amount of money, perhaps too much money, the ones that have the highest market day supply and the lowest retail volume, are the ones that dealers are most proud of with their pricing. As if the longer they're held in inventory, the better they get, like they're fine wine. And we simply know that that's not true. And conversely, those vehicles, those platinum vehicles that represent the best investment opportunities, the ones that we own for the right money or even below the right money, have the lowest market day supply, are the most popular retail vehicles in the market. Those are the vehicles that the dealers are pricing as if they're distressed merchandise, as if they needed to be blown out yesterday. Now, this makes no sense to anybody. Nobody would defend this irrational, what I call inverted pricing profile. But yet, this is what the composite showed me. And I couldn't believe it. I couldn't believe it. So I said to the data scientists, I said, you've got to tell me if this represents 12,000 some odd dealers all combined as one enterprise, how many of these dealerships don't look like this? How many don't have an inverted pricing profile? How many have a rational pricing profile, meaning it looks the way that we would think it should look, and that is that the platinum vehicles, the best vehicles, are the ones that are priced the highest, followed by gold, followed by silver, followed by bronze. Tell me how many have a rational pricing profile out of these 12,000 some odd dealers. And when the data scientists came back with the answer to that question, that's when I knew I wasn't prepared to retire. That's when I knew we would eventually change the way that every single dealer manages used vehicle inventory. Because the answer they gave me was zero, none. Not a single dealer of the 12,000 some odd dealers that this represented, not a single dealer has a rational pricing profile. And then we wonder why? Why are we having difficulty achieving the net profit outcomes that we deserve? Well, no kidding. No kidding. Every single dealer in the country, every single one of you witnessing this presentation today have an inverted pricing irrational profile. And I can prove it to you. Every single one of you. Now, how in the world could this be true? I mean, think about it. How could you ever say that every dealer in the country does anything alike, let alone something that is patently irrational? Dealers are not dumb and they're not crazy. They're anything but. They're shrewd and smart. And yet, every single dealer has an irrational pricing profile, one that is actually designed to suboptimize the return on investment on their vehicle assets. Well, today we've come to understand there are a couple reasons. And the first reason I'm going to demonstrate for you in a very short video right now.
Let's start with two universal truths that we believe everyone familiar with used vehicle sales will agree with. Truth number one, the best outcomes occur when dealers optimize between turn and gross. And truth number two, the passing of time will diminish a vehicle's profit potential. Now, we'll come back to the second truth in a bit, but let's dive deeper into the first truth. The best outcomes occur when dealers optimize between turn and gross. And to do this, let's use the analogy of a seesaw, balanced on a fulcrum, turn sitting on one side, gross sitting on the other. When one goes up, the other goes down, and vice versa. And in the fulcrum, you'll see a calendar, because days in inventory is traditionally how we've managed the balance. Now, historically, I think we can all agree the seesaw looked like this. Dealers put the emphasis on gross, pushing gross up high at the expense of turn. But then this guy, Dale Pollak, comes along with a crazy idea. The idea was that if you flip that emphasis and do it with discipline, really pushing up on turn, something interesting happens. Other factors come into play, and the one-for-one trade-off is broken. Pushing turn up high enough, consistently enough, can actually increase gross as well. Well, total gross, that is. An important part of his idea was recognizing that total gross is the true endgame, and that it can rise even as average gross dips. And this is where we were for a good run. Velocity had proven itself, and the industry accepted the norm that total gross was what should be focused on. That is, until it wasn't. As the trend of margin compression increased, there's been some loss of equilibrium. It's become clear that there is a point at which average gross can dip too low and begin to pull down total gross in a way that more turn cannot overcome. Around mid-2017, Dale began to recognize this condition and, as you might imagine, began obsessing about finding a solution. And one day, a thought occurred to him, which became the seed of what we're going to share with you today. That thought prompted an examination of truth number 2, the truth that time diminishes a vehicle's profit potential. And to examine this truth, let's use the metaphor of ripeness. So, imagine a banana. We can all understand the ripeness of a banana, that it goes through stages over time. On day 1, it's a green banana, full of potential, with lots of time ahead. A few days pass, and you have a perfectly ripe banana. It's in its prime, but it won't stay like this forever, because a few more days go by, and then you have a bruised banana. I mean, this is not good. Its time is running out, and may have already passed. If you were selling it, you'd give it a heavy discount, or expect to throw it out soon, because after a few more days pass, things get ugly. You've got a gooey, rotten banana, and you've got to get rid of it, because it stinks. Okay, you see where this is going, right? In some ways, cars are like bananas. Profit potential, like ripeness, will diminish over time. But unfortunately, cars aren't exactly like bananas. Unfortunately, our challenge is a bit more complex. For one thing, while most bananas age pretty consistently, different cars can age at very different rates from each other. So imagine 2 cars, shown here on day 1, with their profit potential high, represented as green bananas. By day 15 in your inventory, the profit potential of both cars settle in. Here, let's represent this as both cars being perfectly ripe bananas. But by day 30, it's not uncommon for one vehicle to hold its potential longer than the other. Here, the first car is holding strong, while the second car has become a bruised banana. And by day 45, the factors that make that first car a high potential vehicle still remain high. It's still perfectly ripe. While car 2 has dropped off the table. It's a gooey, rotten banana on your lot, and it's got to go. So, what does saying that these cars are both at day 45 tell you about each one's profit potential? Nothing. Day 45 tells you nothing, but hold that thought. There's another way the car challenge is more complex. With cars, you're not always working with a green banana on day 1. Bruised, perfectly ripe, green. Vehicles can be at any stage when you take them in. You might even be taking home a gooey, rotten banana on day 1. Maybe by accident, but maybe on purpose. Maybe you chose to buy a rotten banana to close another deal. And if that's the case, what is saying that this car is on day 1 telling you about the profit potential of that investment? The answer is nothing. Saying a car is on day 1 or day 45 means nothing. The calendar tells you nothing about the profit potential of any given car. Do you see the problem? In both of these scenarios, and many more scenarios throughout the industry, the calendar is the problem. The calendar is an old and crude form of technology, and it tells us nothing about the value of these investments. It's a flawed way of thinking about it, left over from a different time. We may believe it without even questioning it, but we've got to realize calendar time does not equal profit potential.
Calendar time does not equal profit potential. You see, the first reason why every single dealer in the country has an irrational, inverted pricing profile when viewing their inventory through the investment lens is that every single dealer in the country is making pricing decisions on a flawed premise the same way. And when you make decisions on a flawed premise, you often make suboptimal and sometimes just downright irrational decisions. And this is what's happening in our industry. Every single dealer pricing vehicles relies on the flawed instrument of the calendar as a measurement of the opportunity potential that the vehicle holds. And one of the most stunning revelations from our data scientists is that over 50% of the vehicles in a dealer's inventory on day one of inventory life, over 50% of the vehicles in a dealer's inventory on day one of inventory life are in fact bruised and rotten bananas. That's right, over 50%. And yet, what would the calendar say to us? What would the calendar say to a pricing manager they should do with respect to pricing every vehicle on day one? The calendar would say that every vehicle on day one is a green banana and you should price it and go for all the gross. When in fact, today we know that over 50% of those vehicles on day one are brown and rotten bananas. So perhaps think about this. Instead of selling used vehicles for profit, suppose that you sold bananas for profit. And today you get a box, a shipment of inventory in. And you open that box, and to your surprise, what you discover is they're not all green bananas. There are some green bananas, there are some yellow bananas, some brown bananas, and some rotten bananas. Now, if you were a prudent business person attempting to optimizing your return on those banana assets, wouldn't the first thing you would do would be to grab those rotten bananas? And by the way, people do buy rotten bananas. They make banana bread. Wouldn't the prudent thing to do would be to first grab those rotten bananas, put them on the shelf immediately, and price them really low? And then go get the brown bananas, put those on the shelf next, and price those a bit higher? And then get your yellow bananas, put those on the shelf third, and price those higher? And then finally, take those green bananas, put them on the shelf last, and price them the highest. Isn't that what a rational, prudent business person would do with an eye towards optimizing their return on that set of inventory? Of course. And yet, that is exactly opposite of what every single dealer does today with their used vehicle inventory. And again, the first major reason why is that we're all making decisions on a flawed premise, that being that the number of calendar days we hold a vehicle represents the opportunity the vehicle holds. And similarly, what would Dale Pollak have told you about every vehicle in the past at 45 days? I would have told you that every vehicle at day 45 is a rotten banana and it needs to go away. Well, today we know better. Perhaps most might be bruised or rotten bananas by day 45, but not all of them. So you see, today we know better. And one of the questions that you might ask, fairly ask, is, okay, if we've been all making pricing decisions on the flawed premise of the calendar based on calendar time, how is it that we've gotten 100 plus years into this used car industry and never having realized this to be a problem? Well, I think the analogy that begins to answer that question would be this. Suppose that a builder architect designed and built a building using a slide ruler that was a few centimeters off. If they built that building using that flawed slide ruler and you looked at it through a haze of fog, you might not notice that anything was wrong. Nothing was wrong. But if that fog lifted and you looked at that building, you'd say, wait a minute, something's not right. Something's off in that building. Well, for years, what we've been doing is looking at used vehicle transactions through a haze of profitability fog. We were able to make used car profitability so easily, and there used to be so much of it, that we never really could see the fundamental flaw in how we were pricing these vehicles. Well, by the year 2017, and certainly by the year 2018, most of that profitability fog had lifted because the market had become so efficient. And for the very first time, we had the opportunity to look at these transactions without that haze, without that fog of profitability. And what we could see clearly is that the underlying assumption upon which we make pricing decisions, that being the calendar as a reliable instrument of how much opportunity a vehicle holds, is actually wrong more than it's right. And yet, even to this day, it is the way that virtually every single dealer approaches their used vehicle pricing decisions. But in addition to the flawed premise of the calendar, there are other reasons why every single dealer, every one of you, has an inverted irrational pricing profile, and it has to do with human nature and past experience. You see, every human being on the face of the earth is wired to avoid pain and loss. Imagine how miserable life would be if we woke up in the morning to go out to find all the pain and loss we could find. And in fact, we do the opposite. Some more than others, of course, but we actually try and avoid owning pain or identifying or dealing with pain and loss. So if, and I stress if, you are capable tomorrow morning of going to work and seeing a vehicle on day one of inventory life that was in distress, on day one, because you own it for too much money, it's got high market day supply and low retail volume, who wants to jump on that grenade? Who wants to defuse that bomb today? Nobody does. What our natural human tendency would be to do is to say, well, let's give it some time. You know, kick the can down the road. That's what our tendency is to do as human beings. And unfortunately, past experience likely would have rewarded us for kicking that can down the road, because in the past, when the market was not efficient, when customers didn't know what they know today about used car values, it was likely that somebody would eventually come along and take that car off of our hands for too much money, and we never would have had to have diffused that bomb. So you see, what's working here in addition to the calendar premise is human nature and past experience. So you combine these factors together, and they're common to every single pricing decision made by every single manager, and you get what we have here today, and that is an industry that prices hundreds of millions of dollars of used vehicle inventory in a manner that's irrational, in a manner that's actually designed to suboptimize the return on investment. Now, I want to make one more point about the composite that you saw a few moments ago, and that is that you may have noticed that on average, most dealers under normal conditions, not necessarily pandemic conditions, but normal conditions of the past and likely in the present, have a preponderance. The greatest percentage of their inventory falls into the silver bronze category. And I want to tell you what that does not mean. That does not mean that dealers and managers are making bad acquisition decisions. What it does reflect is the very efficient, transparent, competitive wholesale environment. I mean, think about it. What auction will you go to that you can buy a low market day supply, high volume vehicle and get it cheap? No auction. And yet, sometimes you have to go to auction to buy vehicles that you need. And even trading for vehicles today. Consumers today are so well educated as to what the true actual cash value of their vehicle is. How often can you get a vehicle on trade even cheap? Very, very, very infrequently. So there is no shame whatsoever in having a large percentage of your inventory being silver or bronze vehicles. Bruised or rotten bananas, no shame at all. In fact, you really cannot avoid that condition. So there's no shame in it, but I'll tell you where there is shame. Where there is shame is not recognizing them for what they are and treating them as a prudent investor would treat them. But you see, today we're fortunate. Today we actually can identify these vehicles for what they truly are as investments using profit time clock rather than the calendar clock. So we know today, as we've always known, that there should be an absolute age limit upon which we are not willing to keep a vehicle. I believe that. I always have believed it. I believe it today. There should be an absolute age limit beyond which we're not willing to keep a vehicle any longer. But what I don't believe anymore is that age limit should be the same for every car. Today, I know better. Today, I know that some cars don't deserve 60 days and some cars do. So what the profit time approach, the investment value approach does very effectively is it identifies those vehicles that we really should put a shorter time frame on, maybe 20 or 30 days, and other vehicles that we should be more patient for the sake of higher gross through higher prices. And this has proven to be very effective, but it's also proven to be very difficult. This is a very, very challenging new strategy for dealers. One would think that if you simply had new software that would show you every vehicle for the very first time in the new light for what they truly are as investments, that you could sit down tonight and reprice all your inventory and have a rational pricing profile tomorrow. One would think that would be very simple. And at some level, perhaps it would, but it has proven to be very difficult for dealers because what it would cause you to do is to violate many long-standing, unquestioned principles and assumptions about used car management. I mean, stop and think about just a few examples. If you were capable today of going to work and seeing a vehicle on day one of inventory life that was in distress because you owned it for too much money, high market day supply, and low retail volume, the smart thing to do would be to price that car today to move out rapidly. Perhaps put a zero profit price on it. God forbid, maybe put a couple $100 loss price on it. And who do you think would give you a pat on the back today and say, really good job pricing that for no profit on day one? Nobody. In fact, they would do the contrary. And conversely, who would give you a pat on the back for sitting at the sales desk today and turning down an $1,800 gross profit and saying, good job we didn't take that $1,800 gross? Nobody. But in fact, if that were a platinum or a gold vehicle and you put a higher price on it and you were willing to be a little bit more patient with that vehicle, unquestionably, it would have produced a $3,000, $4,000, $5,000, $6,000 gross. But nobody will ever see it that way in your store today. Nor will it conform or reward you with your current incentive program. So you see, what this really takes to implement properly is a high level of discipline and commitment and understanding within your store as to why it makes sense to do something different. And none of us should ever expect anybody in our store to do anything different unless they understand why it makes sense to do something different. But what we know today is that the way we're pricing our vehicles is absolutely irrational, suboptimizing our returns. And listen, today under these very unusual and fortunate pandemic conditions, you don't have to do anything different. You're probably still doing very well, maybe even record well. But the reality is that there are dealers that are doing even better. These are the dealers that have come to recognize that if you change the way that you price used vehicles, move from doing something patently irrational to something entirely rational, you'll get even better outcomes. And what we know definitively, objectively, is that those dealers today that have been able to implement a successful investment-minded approach to managing used vehicles using the Profit Time software actually perform even better. They turn vehicles on average 4 days faster. They sell an average more vehicles, 98 versus 81 vehicles per month, and impressively gross an additional $400 per car front and back. Now, I would suggest that if we were in what I consider to be the true normal of our used car industry, these differences would be even much more significantly greater in favor of the Profit Time dealers. But again, you know, these are very unusual conditions, one where basically a dealer can have no strategy, have any strategy, and they're going to do very, very well. But I remind you, the true mark of a leader of an organization, the true mark of the greatest, most successful long-term dealerships are ones that are never satisfied, no matter how good the outcomes are. They always are open-minded and looking for opportunities to do even better. And I believe that there are few and perhaps not any opportunities in the automotive industry today that are as fertile and fruitful as this one. Because when you change from doing something patently irrational, which you are, to doing something completely rational, what you can expect and what you will see are absolutely tremendous improvements and lift in your profitability, your volume, and your turn. So I want to take this opportunity to thank all of you for participating in Cox Automotive's Fall Expo and say thank you for permitting me to share some of your very, very valuable time with you today. Thank you.
Thank you, Dale. Now, I don't know about you, but I was struck by the performance of dealers who manage their used vehicles as investments and how they compared to those who follow a more traditional management strategy. The numbers were very telling, proving, as Dale noted, there's an opportunity for dealers to do even better.